we're going to move on to our speaker today, and everybody looks forward to Sharon's talk about our financial outlook. But I'm going to introduce Bill Jackson, our day chair. After working for 44 years in the construction industry, constructing projects in 2 foreign countries and 15 states, Bill retired almost 12 years ago. In retirement, Bill has not stopped traveling or working in construction. As many of you know, he is very involved in the things we do here. Bill continues to use his construction management skills and is getting ready for his 7th trip to Honduras to check on the construction progress of the Rotary Global Grant for Mila Trace, a water distribution project. 7 years ago, Bill joined Engineers Without Borders, and with a team of engineers over a 3-year period, engineered and constructed a 17,000-gallon water tank, a 3-mile pipeline, and a suspension bridge in Mila Trace, Honduras. The total replacement of Mila Trace water distribution system in the nearing completion was started 2 years ago with a $155,000 global grant sponsored by the City of Lakes Rotary Club. When Bill isn't traveling to Honduras, he and his wife visit his son and family in Saudi Arabia and his daughter and family in Tanzania. And her family in Tanzania. Fortunately, they only have to travel about 10 miles to see their son and family that live in St. Paul. So not across the world. With 5 grandkids, ages 6 to 10, Bill and his wife want to see them as much as possible before they grow up. When not traveling too far away places, to those faraway places, Bill and his wife like to spend as much time as possible at their cabin in Spooner, Wisconsin. Bill joined the City of Lakes Rotary Club, the greatest Rotary Club in the world, almost 5 years ago, and has enjoyed making so many friends, new friends, and that all want to make the community and the world a better place for all. Please welcome Bill.
Well, I have the pleasure to introduce Sharon Bloodworth. She's coming back to us again, giving us kind of the state of the economy. Sharon is the CEO of White Oaks Wealth Advisors, one of the largest independent investment advisory firms in Minnesota, wholly owned by a woman. Sharon has been widely quoted and frequently speaks at conferences and to private organizations and CEO roundtables. Born in the UK, Sharon has lived and studied in Africa, Asia, and Europe, and speaks multiple languages. In 2007, she funded the rebuilding of a kindergarten in Indonesia that she named after her daughter, Sophie's Sunshine School. How special is that? In 2021, she added a library to the school. She was honored as a 2013 Top Woman in Business and 2010 40 Under 40 recipient by the Minneapolis St. Business Journal. Excuse me. In 2019, Sharon received the Marty Baskerville Philanthropy Award from Rotary Club 9, which is awarded for lifetime achievement in philanthropy, and the Vestige and Lifetime Achievement Award for leadership as a CEO. Sharon has been a member of Rotary Club 9 for 19 years and served as its president 11 years ago. She has been elected district governor of our district 5950 for 2024-2025. You'll really get busy then. Sharon co-chaired 2 district conferences and was a program co-chair for the 2021 Rotary Zone Institute. Sharon is also the immediate past vice chair of the Minnesota Opera Board and current chair of its investment committee, and a member of the Minnesota CEOs Against Cancer chapter of the American Cancer Society. Welcome, Sharon.
Lovely. Hello, everybody. It's so nice to be back. I can't believe that Lloyd Campbell is joining us today. He told me when he came to our Club 9 that ours was his favorite club. Did he say that on yours as well? Just checking. And Julie as well is also on the line with us as well. So it's kind of crazy that you've got the DG line here. And so I can't believe that they've all woken up to hear me talk on this sort of topic. And then Christine Krass says hello. I sent her a picture of all of you this morning, and she was really excited to say hello and misses you all. And so she and I had some fun in Venice, Italy last year. So it was, it was quite a giggle. And then for the song that you have, kind of what goes up must come down. The talk today is the reverse. We're going to say what goes down must come up. And we don't have a lot of time today. And so if I had to do, we can carry on with the baby shower, but I would say the talk is don't worry, be happy. So maybe we'll just sing about that. So let's take a look. So first of all, I always give kind of the same advice, is that truly ignore all the noise that you hear. The media only tell us what they think we want to know, which is not usually the truth, and you shouldn't be paying attention. And it's really poor for your investment decision making to pay a lot of attention, and it's not great for your mental health as well. So I would say that, and as we know, newspapers, need to sell advertising, and so it's always the kind of the screaming headlines that get you. I've had a few client calls over the past couple of months, or even one that visited the other day that just said, let's talk about my family, but don't even tell me about the markets. Like, don't even tell me. And I just thought, oh gosh, last year actually wasn't that bad. And so you can tell kind of the level of information that's out there that's swirling around that just gets people, really uptight. And so when we, so just think of yourself, if you're a puppy, just put your hands over your ears and just ignore everything. If you look at the biggest global risks in a poll that was done in 2023, it goes from ranking from more impact to less impact, and then up on the right-hand side, it's the share of respondents. People, when they look at the most global risks of 2023, are actually looking at the energy supply crisis and the cost of living crisis. Many of those have been impacted by the war in Ukraine. And then amazingly, people, the blue one, I think I have a little thing here. The blue one here is the debt crisis. It's like, I wonder why people aren't worried about that one. So it's quite interesting where people's heads are. And then, of course, we've had the spy balloons that have been kind of over us over the last couple of weeks. But I always think, again, you have to roll back and think about it in a rational, sane mind, that if our countries are very connected from an economic perspective, then it's probably going to be just fine. And you can see that here post 2020, if you kind of do a line here, this is US commerce with China. Again, it's on the rise, despite all the national security tensions as well. And so we're very, very connected as countries. So it's in nobody's interest to start anything else. So again, keeping a cool mind about that is important. The overlay of this is actually the S&P 500 in 2022. So it's kind of a wild ride. So a couple of lovely ups, what must come down comes back up again, goes down, comes up, goes down. And so we were really whiplashed last year. You're either feeling really great and thinking everything's wonderful, or you're panicking. And don't forget that the market is truly emotional. And a lot of the reason for the ups and downs last year was related to Chairman Powell. The market behaves. The market behaves truly like a petulant child, in that, nobody wants to have interest rates rise. And you think, we have to have increased mortgages, increased borrowing. And so then, again, the market panics when they think that if bad news comes out, that's going to be even worse, and we're going to, have rates rise even faster or higher than they have. And so it's been a kind of a crazy ride to watch. But that's why, again, you should just sit back and not worry about the markets as much, because they will vacillate around. And as you know, economists are not hardly ever right, like the weathermen aren't either. And so it's important to always take that with a grain of salt as well. So when we look at, again, sort of Powell's comments, is that it's really been quite crazy. And I would say that from an inflation perspective, and an interest rate perspective, is that some inflation, it's not bad. If you think about it, for many, many years, we haven't got paid in our bank accounts. There are millions of retirees in the US that hardly got paid anything for their bond portfolios, and that's just a miserable environment. And so some inflation is really, it's not a negative thing. It's actually quite a healthy thing for a country, and especially for a portfolio, but it's getting back there. It's going from nothing to getting back there. And I know that for some of the younger generations, when they see mortgage rates near kind of 5 and 6, they'll go, oh, that's terrible, that's awful. And I can tell you that, if everybody in the room turned around and said, well, my child, let me tell you about the 1980s, then you really wouldn't be complaining at all. And so now, and it's all a matter of perspective. So when you see 6% in mortgage, that's not so bad. And it does cool down a real estate market that has been, on a personal side, it's been very, very hot for a while. And it actually prices a lot of people out of being able to access homes. So, it's not a bad thing. And then, of course, if you think about if you have a new generation writing for some of the kind of financial papers, if you think about their year last year, their Bitcoin was destroyed, rising interest rates, and then for the first time they heard about kind of technology layoffs. So again, all of the darlings of Facebook and Google and Amazon have announced significant layoffs. And so you think, so when you look back at last year, you think, that must have been a hard year. And especially again, if you look at some of these things. So this is again 2022 for the year. And you can see the S&P 500 lost 19%. The All Country World Index, which is global, and US stocks lost 19%. If you're in the NASDAQ, so you're a little bit techie and like growthier, you were down 33%. And then, believe it or not, the bond index was down 15%. And that's wild again, because again, if you hold bonds, your expectation is not that you're going to lose as much. So last year, again, there really wasn't much place to hide unless you're in alternatives. But if you break that down a little bit further, you can see that here. So this is the S&P 500 in the middle, kind of down, 19, 20 for the year. But if you look at where value companies were, they were only down 10, and it was really growth that was down 30. So depending on where you are in the markets, you could have had a very, very different year last year. And our firm, we're a value, much like Warren Buffett. So for the prior 5 years, we looked really boring and dull and outdated. But now times are really great, and last year was really great. And so every person has their day. However, if you were somebody who had got caught up in some of the larger tech stocks, which everybody said could do no wrong, last year was a really, really, really horrible year for you. So you can see here, Facebook was down 64, Netflix down 51, Tesla down 65, Apple down 26, and Amazon down 50. So you can see the perspective of, again, if you have a growth portfolio and you're in Bitcoin, then you can see why the noise was a little bit louder last year for things being terrible when they actually weren't on the face of it. And I always say the best advice always, my favorite Nobel Prize winning economist says that your portfolio should be like a bar of soap. The more you pick up and use it, the less you'll have. Like the more you pick up and mess with it, the less you'll have. And it really is true. And we're whipsawed into thinking that we should make changes in our portfolio and react to the financial news that you hear. And you really shouldn't. If you've got a diversified portfolio, just let it run. It's been proven that if you get in and out, it's based on emotion, and it's nearly always the reverse. Our brains are wired to actually do the wrong thing in the markets, which is why you should index and just leave it alone and not touch it. So I love that. However, in the COVID era, please be picking up your soap lots. So now when we look into 2023, what are we going to have for this year? So I know that your ski jumps and all of your skiing is almost over. Ross, he was lamenting that this morning about the rain. So I thought, being in Minnesota, we'll have a few ski analogies. So are we going to jump off this wonderful market into a recession? And do we expect a soft or a very hard landing? Will we need people to help us dig us out? Or will there be no landing at all? And so that really is the key of the next few things. So if we look at recession likelihood, this is the Wall Street Journal 70 top economists in the country, and they're asked whether they expect recessions or not. Anytime there's a break in the chart, it just means that they weren't asked that question in a particular year. Funny how after a deep recession, they no longer want to talk about recessions. But there you go. So right here, we're here where it pretty much says that 60% of economists believe that the US is going to be in a recession in the next 12 months. And interestingly, though, if you look at this chart, is that, other than them actually saying we're going to be in a recession when we're in a recession, which is this gray part, very rarely do they actually, all think that a recession is going to be as likely during a time where we're not. So I think that's an interesting point. And then here, when they say, well, when is the Federal Reserve going to cut interest rates? And you would only cut again when you're in a recession environment where you're trying to, again, help people be more confident and boost your way out of it. You can see that the clear consensus here is in the first quarter of 2024, and some are coming into 2023. Now, if I showed you all the charts I'd shown over the last few years, they're always wrong. They're right eventually. Yeah, they're right. I mean, there will be a recession eventually, so you don't need to look at this and plan your business accordingly, because again, if you made decisions based on some of these things, it would be a very poor thing entirely. For example, retail sales had a horrible last couple of months last year. And so then if you think, oh, well, then if I have Target, why on earth would I want to hold Target in my portfolio? Whereas if you look at what Target has done this last month, it's the exact opposite. And so again, never act on this advice or the data up here. One of the joys of working in this industry is creative thinking that comes from some of our kind of industry pundits. On historically, everyone was told that if you had 2 negative quarters of GDP, you're in a recession. Well, we did have that last year, but it was announced that, well, that's not actually a recession. And even the White House sent out a sheet explaining that what we regarded as what a recession isn't a recession. And so really it is the National Bureau of Economic Research are the ones that call the recessions, and it's really based on, go back here. It's really based on other, these other factors here. And industrial production, retail sales, consumer spending, and so forth. And then in this heat map, you can see when it's red, it means that again, it's the expectation is that it's going to be negative, and then yellows are in the middle, and then obviously green is good. And so when they look at the combination of all of these factors, then they believe that again, if everything's not doing well, then you're in a recessionary environment. But they generally don't say you're in a recession until you're already in a recession and they've already, seen that you're there. So it's too late. And as you know, with the market is that if the market prices in a downturn, then it says, okay, well, when you're in the downturn, oh, well, it's a better day in the future, so everything's going to go up. So if you pull back on your portfolio and you're in a recession, that's, again, the single worst time you can be doing that. So 2023, this is the Atlanta Fed estimate, which I think I showed you last time. They kind of forecast where they think GDP will be coming up for this first quarter, which will be out at the end of April. The blue chip consensus is it'll be a negative quarter, but their view right now is that it's going to be a positive quarter. So we'll see. Profits are really healthy. I always like to just sit back and look at this chart and go, wow, isn't this amazing? So if you go back to 1992, and this is 2022 here, you can see that, S&P 500 profit margins back then, again, were in this 4 to 6 to 8 range. Well, look how far we've come up. So even though we've given up some, since 2020, we're still in an amazingly profitable environment. When I look at, every single private company CEO I spoke to last year had a record year last year, having great years this year. There's a lot of really healthy things happening on the underneath that people aren't really talking about. And yes, a lot of people have been laid off, but however, so what's bad for people is often good for your portfolio, sadly. It pretty much is the opposite way, is that when people start getting laid off, well, then that means that companies, again, protect their profit margins, and people are expected to be more productive. Which is always, again, a good thing for your investment portfolio. So profits are still very, very healthy. This is the retail sales I spoke about, but the expectation, again, is that this month will be more positive. However, people have been slowing down because of the cost of goods as well. Shipping costs are pretty much returned to normal. This was a wild one where we learned again from our friends in the industry how much it would cost again to ship a container from China over here, where literally it went from kind of being in this 5 range, right up to 20 during post COVID when everybody wanted everything at the same time. But it's nice to see that, that's come back as well. And then how is that? And if there's one chart that I want you to take away from today, it would be this one in terms of how the consumer is feeling. So here is where we're feeling right now. And you can see obviously kind of this is the average where we feel a lot better, kind of over the 85 mark. So we're still, we're improving, but it's still very, very depressed relative to where we usually are. And so you think, oh, well, does that mean that consumers are still really, sad about the future and really kind of worried about things? And the kind of questions they ask them, again, a large ticket items is like, will you buy a refrigerator in the next 5 years? Will you buy a washing machine? Things like that. So bigger ticket items. So it is coming back, but take a look at this over here. And this is the real takeaway to say it should be opposite day. So here, whenever you go through a peak in consumer confidence, then the following 12 months in the S&P 500 is up 4. But however, if you invest when you're in a trough for consumer confidence, your following subsequent 12-month return is about 25%. So again, the thought is when everybody's feeling lousy, you should be thinking everything's going up. It's going to be a great time, and not be so worried. So again, don't buy into all of the media kind of misery and just think, oh no, the future is going to be horrible, because generally it is the most opportune time to invest. Same within real estate. If everybody's running away from real estate, then that's usually the time to get in. It pretty much is if you do the opposite of what everybody else is thinking or doing, you actually do pretty well in the markets. And so that really is food for thought again, is that, if you hear the highlighted news about consumers not feeling very confident or happy, then, just embrace this chart as well. And then, what if we're surprised on the upside? What if there is no landing and we're parachuting down and there is no actual recession? This very interesting chart shows you that if these different kind of sectors in the market have a 1% rise in revenues, it shows you kind of the operating leverage by sector that each one of them has. So you can see how well energy, financials, materials do as well. So you can be quite surprised on the upside. But most of what people have been concerned about is inflation. So you can see again, it's there's been a massive surge in egg prices. All of the products have gone up as well. However, inflation has started to fall. You can see here, which is really nice. But if you break apart the numbers, you'll find that it's falling. Services are going up, so but costs of goods are going down. So it depends on what you're buying as to whether how you're impacted. And then the inflation forecast over time. This is where we are in an actual. And then again, from an economist perspective, they still believe that, in 2025, it'll be further down into kind of, quite normal environments. And we'll see if that happens. Every Tom, Dick and Harry has raised their prices, and everybody's taken advantage of that. And so generally there are some people that are slower than others, and so they've just raised their prices. So I think it might take a bit longer of a knock-on effect on that. And then wage inflation, again, is that, you've been through sort of incredible wage increases. But however, if you adjust them for inflation, we've actually gone backwards as well. You can see this is December 2021 is the little gray marks. And then the pink is 2022. So you can see utilities information and different kind of hourly wages on average. So all of them, except for information, have taken a bit of a dip. And then again, unemployment to job openings. We hear that there's a lot of people available for jobs. So I would say that if you look at employment, is that you're generally the other than the kind of the great resignation, you've had a lot of the employees that have already gone back to work. However, the issue is that employers have expanded the number of jobs available, and that's where the gap is. And so that's been pretty significant. This chart here shows you this is a surplus of workers, and these are the filled and open positions. And you can see here we're in a negative thing there. So we still have more jobs available than people who are willing to do it. And so, however, if you look at the change in employment here over the last couple of months, again, accommodation and healthcare, so a lot of kind of restaurants and hotels and everything are coming back there. But the interesting thing again is that there are two factors that have gone into this disappearance of workers as well. One is that we're aging. So you can see that back in back in 2011, you had sort of far fewer people that were aged 65 years up. I think that was in the 13 range, and now we're up to almost 17% of 65 up. So the issue is again is that we're an aging population and we have fewer workers, and even in this zone that's the 15 to 64-year-olds, which that you sort of your population that's going to work, that has been diminishing over time as well. So you have fewer workers there. However, again, is that we know that a vast majority of retirees don't have retirement savings, so they'll be forced to work longer. And so the thought is that a couple of economists really did a deeper study on where on earth people were from an economic perspective, or sort of not turning back, sort of not having come back to the workforce. And the belief is that it's because also a lot of people are ill with COVID or other things, that they're just not working at the same time. And so that's really what accounts for that. And so again, hopefully that will resolve itself. And then here, this was just another chart that shows you how if you look at boomers and seniors, this is the point where you've saved 100,000 or more for retirement. So the vast majority of retirees in the retirement zone have only saved sort of under 100,000. As you know, if you have 100,000 in a portfolio, our recommendation would say, well, you can take 3,000 or 4,000 from that, and that's it for it to sort of continue. So that's not going to keep somebody in retirement. So I think retirement will look very different. And then will you be replaced by robots? Well, there's a lot of things that you can be replaced for. And so, or you can be a graphic designer. So no worries for Brock's skills. Or lawyers or writers, again, you'll still be there. However, when you do get this sort of change, then it does accelerate innovation. This is in the UK, how many workers were employed in agriculture, and then again, the agricultural output. So if we do end up with a perpetual employment issue, well, then on come the robots even faster. And then interest rates have hiked really quickly. I'm just going to scroll through these in case you have questions. The Fed funds are not expected to come back until later. This is little dots of what all of the Fed fund chairman and governors believe with interest rates. Real estate prices are still holding fairly well. Rental markets now, thankfully, are staving off. And then lastly, I really want to talk about currency differences. If you haven't noticed or if you haven't traveled, the US dollar is extremely strong, and this is relative to the pound, the yen, and the euro. So it's time to travel. So if you are miserable, get your stuff and it's time to travel. And then really, if you think about it, it's time to visit all of your Rotarian friends overseas, because again, the exchange rate is just wonderful. And if you haven't discovered Amazon, that's not the US one, but if you go to Amazon Japan or Amazon UK, you're buying in their currency. So my husband has everything he wants from Japan possibly delivered. So there you go. So close your ears, be a happy dog. And ignore the noise because it's going to be all right. There you go. I have 1 minute for questions.
So do we have time for any questions?
Yes, I'll stay.
You'll stay. Okay, that's great. So I know you're interested in books. You funded a library, so we have an opportunity for you to sign a book that will be given to a at-risk student, and we partner with Way to Grow.
Thank you.
Have a pen to sign it, and then you get to keep the pen that has your name on it.
And the book is My Father's Dragon. In my high school team, we were called the Komodo Dragons. So
good.
Yes.
Okay, well, thank you very much.
Thank you.
Wonderful. Thank you, Sharon. Thank you, Bill. All right. I want to also thank our volunteers for today, our greeter, Anna Presicari, reflection from Sandy Christensen online. Awesome baby shower, speed baby shower, it felt like a little bit, but Mary Pat and Jean, and congratulations, Adekunle. We hope you can continue to get some sleep. Our day chair, Bill Jackson, Zoom masters, Brock and Greg, club administrator, and Anna. Yes, thank you, Anna. Anna Cosgren, Club Administrator Dick, and thank you guests for joining us today. It was wonderful to see you. So next week, let's see, I have a question for everyone. Who here has a smart device? I'm sure everybody has a smartphone. Have you heard of the Internet of Things? Yes. Anyone think that Siri is always listening? Yes. I'm surprised she didn't speak right there. But anyway, so Justin Grammons will talk about applications of computer vision and the future of work. This talk will discuss the power of these devices, what they have when they're connected with each other over the internet. As these smart products come in all shapes and sizes, they will continue to influence how we live our lives, both in our homes as well as in the future of work. On March 1st, I will give the annual state of the club. And then on March 7th, Jeff Olson, one of the Minnesota hockey greats, will talk about homegrown talent in the NHL. With that, please be safe. I'm not sure if it's slippery, but go out and have a wonderful Rotary week.